Hi, I'm John Bloomfield and welcome to my blog. I was going to write a post today about investment diversification. As I was starting to write it, I realised what a complex subject it is to explain in writing, although it's actually quite a simple concept. So I thought about how I would explain it to you if you were sat in front of me, and I realised it would be using visuals. So I thought, unusually, for me, first time I think, I'd do my blog post in the form of a video. I hope it works out. If it doesn't, I won't do it again. Thanks very much for watching.
Diversification. In the term of investments, it simply means mixing different asset classes together in order to achieve a diversified portfolio. But the reason we do this is one that can be quite difficult to explain in the form of a blog post. So as I said before, it's better to work through it using the first infographic I've ever seen, and I think it was around before I ever heard the term infographic. Advisors often call it the mosaic or the patchwork. It's quite a simple table really. You have along the top the years, and in the columns you have different types of investment, different asset classes. Each one has a different colour and they're listed with the number of the return that they gave in that year below them. So it's like a league table. The top performer of the year is at the top, the worst performer of any one year is at the bottom. Data of which data has been used to calculate this is at the bottom here. It's been put together by Optimum Investment Management, which is one of the fund houses we use. Others. Lots of other fund houses have also put this chart together, and I'll show you another one at the end, which is a little bit different and serves to illustrate something. But this one illustrates this point at hand. Individual assets go up and down. If you had all your money in a single asset, you'd be in for quite a bumpy ride. If we look at commodities to start with, top performer in 2000, near the bottom in 2001, back to the top in 2002, a little bit of consistency in the mid-2000s, and up and down, up and down. Quite a volatile ride. And we see this pattern repeated for every asset class. Depending on the type of asset, some are more volatile than others, i.e. they bounce up and down much more, but there is no asset class that maintains a consistent, positive, up near the top of the table return. So UK property is the same, non-government bonds is the same, global bonds are the same, government bonds, similar performance, small caps, up and down, cash, up and down. So as you can see, even the old favourite gold can take a plummet now and again, also take a big rise as well. European equities, UK large caps, Japanese equities, and finally Asian equities. Now, the point I'm trying to make here is that no single asset is constantly at the top of the tree. You can see gold's had a few years up there, UK small caps had a few years up there, but they've also lost a lot at different times as well. So for example, 2006 UK small caps are up there, as you can see, at 22.87% for their return. But the year before, they were quite a bit lower down the table. But if we look at Japan, for example, 2005, top of the table, losing money in 2006. So you can see it's quite a volatile ride. The process of diversification is taking a little bit of each asset class and mix them together to build a portfolio that is more consistent, less volatile, and targeted toward an investor's individual aims. We work out, as financial advisors, what is the right mix of assets for you based upon your psychological profile, as in your attitude towards risk, what you can emotionally handle, what you can actually afford to lose, what you can afford, what you need to gain, the time frame that you have in order to gain it, the resources you have to put into your plan. Now, the point of this table is, and something that I think we need to point out is, lots of clients will come to us and to our financial advisors wanting to get on the next big thing. What's going to be the biggest performer next year? That is not investing. That is gambling. No financial advisor worth of salt is chasing a 1-year return for you. They want a good financial advisor is looking to find out what your targets are, what your aims are, what your attitudes are, what your resources are, and get you to achieve your goals and your targets. Trying to pick the next big thing for the next year is just gambling. It's just taking a punt. You could get it right, you could get it wrong, it could go terribly wrong, it could go terribly well. So we would never advise anybody who wants to chase the next big thing to consider an investment. It's a punt, and it's not something you should be doing in order to achieve your long-term aims. Diversification definition is there. Leave it on the screen for a few moments so you can read it if you wish. Essentially, by diversifying assets, we put different asset classes together that some will have a similar relationship to each other, some will have an opposite relationship to one another. When one goes up, one tends to come down, and some will have no correlation at all, as in they could both go up at the same time, both come down at the same time. But what we hope is that by putting together a diversified portfolio, we can narrow the risk down, reduce the volatility, get more consistent performance in line with what our client needs in order to hit their goals and achieve their targets. Now, the table again, another mosaic. This time it's been put together by JP Morgan. Includes an extra column. It's in grey. It's called portfolio. This is one of JP Morgan's ideas of a blended portfolio, a mix of asset classes. The definition of what's in the portfolio is in the small print at the bottom. It's not necessarily a portfolio we would use. We have roughly 10 different asset models, and we do adjust them slightly for client needs, depending on, again, the client's target, what they need to achieve, when they need to achieve it by, what resources they've got, what their psychological profile is, generally how they feel about the market. It's an investing generally. This is one portfolio put together by JP Morgan. Now, just to join up the dots, what I hope you can see is that over the years 2004 to 2013, you have a much more consistent performance. It's never at the top of the table, rarely at the bottom of the table. It takes a middle course, hopefully gaining most years, although it will lose some years like any form of investment. What we see is in the last column, which JP Morgan have added, is the 10 years annualized return, i.e. the average return that the investor got each year. So we can see the investor in the mixed portfolio ended up with a return of 7.9% on average. The person who in 2004 managed to get in on REITs and get the highest return ended up with less. The world, excluding the UK, was the top performer in 2013. Their average 10-year return was less than the portfolio. IG bonds sometimes come above the portfolio, so it's come below it. Overall, it's averaged out lower. Cash, of course, does terrible, always does. So there we have it. I hope I've simply explained diversification of assets. If you want to ask questions, just drop me an email, comment on this blog, whatever you want. Easiest way to get in touch for you is the easiest way for me. Thanks for taking the time to listen.